Hello everyone. I will talk about money flow in Japan, along with the functions and roles of trusts. It is said that money comes and goes around the world, and money flow refers to the travel of money all around the world. It examines how money flows within Japan, from Japan to overseas, and from overseas into Japan, while also examining the scale and the amount. As money travels around the world in this way, today I would like to explain 1. What kind of money makes use of trust mechanisms, and 2. How much is available and how it moves, and 3. What the functions and roles of trusts are in this movement. The travel of funds, in other words, money flow, for Japan can be ascertained from the flow of funds accounts compiled by the Bank of Japan. Figure 1 shows the flow of household funds according to the flow of funds accounts. The figure shows that the balance of financial assets of households is about 1,900 trillion yen, about 3.5 times the nominal GDP of Japan, which is about 550 to 560 trillion. Of this, about 97 trillion yen is in cash and 937 trillion yen is in savings, indicating that the shift from savings to investment is not progressing much. These household funds are invested through banks, investment trusts, insurance plans, pension funds, and more in a variety of ways, some of which include loans, Japanese government bonds, domestic stock, and foreign securities. In addition, from banks, investment trusts, insurance companies, pension funds, and others, these assets flow into various financial markets, including JGBs, domestic stocks, and foreign security investments. Looking at this money flow, investment trusts account for only 3.8% of household financial assets at approximately 72 trillion yen, while trust beneficiary rights, which are trust products separate from investment trusts, account for only 4.5 trillion yen. A mere 21 trillion yen makes up the size of joint trusts, which are an aggregation of various trust products. Although investment trusts make up a relatively significant amount, they do not have a strong presence in the overall scheme. So, where are all these funds? In fact, these investment trusts, insurance funds, pension funds, and public pensions are called institutional investors, and it exists in this intermediate area which invests money into government bonds, domestic stocks, and foreign securities investments. These institutions exist in this intermediate area, but they do not appear in the statistics from the Bank of Japan. I will describe more about this in the following page. As an example, let's look at the public and other pension funds which manage people's retirement funds. Public pensions mainly refer to the National Pension and Employees' Pension Plans. A non-government pension fund is a pension plan established by a private company which employees and companies make periodic contributions and use these funds to pay retirement benefits. Figure 1 seems to show that both public and other pension plans are managed internally. However, as shown in Figure 2, public and other pension plans entrust most of their funds to entrust banks through trust products called pension trusts or money trusts. Using their investment know-how to make their own decisions or acting as a vessel to follow investment instructions received from pension funds, trust banks invest in a wide range of areas such as JGBs, stocks, and foreign securities and return the investment income back to the pension fund. The role of trust banks as providers of know-how and investment vessels is not reflected in the Bank of Japan statistics, and thus the role of trusts appear to be small. In fact, however, trust banks play an important role as a bridge between household investment funds and financial markets. In this trust relationship, public and other pension funds are referred to as the trustor, and trust banks are referred to as the trustee. Pension funds and public pensions are also beneficiaries as they receive the profits earned by the management of the trustee. Please remember these three important roles as they always make an appearance in trusts. Trust banks' asset investment and know-how functions are not only used in public and other pension funds. For example, with investment trusts, investment trust management companies entrust the funds collected from investors to trust banks, which then carry out trades as instructed by the management company, thereby acting as an asset investment vessel. Additionally, when overseas investors invest in Japanese stocks and bonds, they make use of these investment vessel and know-how functions through money trusts. Figure 3 shows the breakdown of trust products which provide the investment vessel and know-how functions, and that they approximate 470 trillion yen in total. It is comparable in size to insurance company financial assets of 520 trillion yen. In this way, trusts play a significant behind-the-scenes role in the flow of money, in that they contribute to the dispersion of money domestically, internationally, and in attracting foreign money into Japan. What are the specific advantages associated with these investment vessel and know-how functions used by public and other pension funds? When money or other assets are entrusted to a trust bank, ownership is transferred from the trustor to the trust bank. This differs significantly from bank accounts which remain in the customer's name. On the next page, I will explain more specifically why institutional investors want to go so far as to give up ownership of their funds to make use of these investment vessel and know-how functions. Next, I will talk about the fundamental functions of trusts, which exist within the asset investment vessel and know-how functions. There is a large amount of variation among trust products, but all trust products are based on a combination of certain fundamental functions. For this reason, these functions can be thought of as the essence or soul of trusts. When money is entrusted to a trust bank, the trust bank as a trustee is subject to strict legal obligations. The first of these is the duty of care of a good manager. This states that special attention should be paid as a good manager. The second is a duty of loyalty, which means that action must be always taken in the interests of the beneficiaries. The third is the duty of segregated management, which states that there should be a strict distinction between the trustee's own property and that with which they have been trusted. This only eliminates the concern of misappropriation of funds and scandals, but also relieves the trustor of complicated clerical work. In this way, the stability and security of asset management is increased. This is referred to as the asset management functions of trusts. I think it is now easy to see the value of such a system for institutional investors. The second function is the bankruptcy isolation function. It may be a bit difficult to understand this concept with words alone, so I'll use pension funds as an example. If a pension fund or trust bank were to go bankrupt and lose all the pension funds which were put aside to pay for people's retirement, it would result in quite a tragedy. However, by entrusting the pension contribution payments, the assets are transferred from the trustor to the trustee, which means that in the event that the trustor, the pension fund or parent company, goes bankrupt, the pension funds will be unaffected. Furthermore, entrusted assets are held legally independent and thus are not affected by the bankruptcy of the trustee, in this case the trust bank. Thus, the money entrusted is isolated from the emergency of bankruptcy, and this is referred to as the bankruptcy isolation function. Whereas the asset management function is intended for times of normalcy, bankruptcy isolation means that the security of the investment funds are ensured even in the event of an emergency. Again, I think it is easy to see the value of such a system for institutional investors. The third fundamental function is the conversion of property rights. Put simply, this makes it easier for many people to participate in the management and procurement of money. It makes it possible to make effective use of the world's funds. It makes it easier for individuals to accumulate wealth. It makes it easier for companies to acquire funds. Why is this possible? Because when investment funds are entrusted, property rights change from ownership rights to trust beneficiary rights. This is the right to receive profits derived from the entrusted property. Trust beneficiary rights are considered to be securities just as stocks and bonds, which means that trading, exchanging, and division become easier. Investment trusts make use of this conversion function. On the following page, I'll explain how investment trusts work. As shown in Figure 4, investment trust management companies which provide investment trust products pull together funds from various investors and then entrust them in exchange for trust beneficiary rights, which are then split up and handed over to the investors based on their investment amounts. This mechanism allows investors to invest in a wide range of stocks and bonds, even in small monetary amounts, through the investment trust products offered by the investment trust management company, thereby providing customers with a wider range of investment choices with which to build their asset portfolios. In addition, when an investor wishes to withdraw his or her investment in exchange for cash, the trust beneficiary rights can simply be sold off to someone else. The companies which issue stocks and bonds, which are traded in financial markets, will also be able to build a diverse investor base using the system, enabling them to invest in facilities and to venture into new business fields with the money they have raised. Also, for institutional investors, they are able to enhance their financial intermediary functions, or the ability to match lenders with borrowers, leading to greater fulfillment of their social purpose. Again, I think it is easy to see the value of the system for institutional investors. The fourth fundamental function is the investment function. Literally, this means that trust banks can leverage their sophisticated investment know-how and higher investment yields can be expected than with individual investors. So, what is the actual investment ability of trust banks? Let's look at the data on public and other pension funds. Investment performance data for trust banks alone is not available, so today we will use data for the entirety of investment funds, including that for investment institutions other than trust banks. Figure 5 shows that public and other pension funds experience very high volatility in investment yields. Over the past 20 years, in general, we have seen 2 wins, positive returns, and 1 loss, a negative return. Investment performance has been heavily influenced by such factors such as the collapse of the IT bubble in 2000, the 2008 financial crisis, the Great East Japan earthquake in 2011, and the crash of Chinese stocks in 2015. Performance is not necessarily stable. However, over this 20-year period, it was possible to secure an annual return of 2.4 to 2.6%. This figure exceeds the nominal economic growth rate and fixed deposit interest rates from the same period. Despite the challenging investment environment, the effectiveness of long-term and diversified investments, along with the investment know-how of trust banks, was adequately proven, leading to relatively good investment performance. Up until this point, we have looked at trust functions from the viewpoint of money flow in Japan, i.e. money. However, these trust functions are not limited to money only. By utilizing the fundamental functions of trusts previously described, items other than money, such as real estate, securities, and other assets, can also be transformed into trusts. As shown in Figure 6, the balance of trusts comprised of assets other than money has reached approximately 320 trillion yen, which is quite a large amount. A common type of trust, which is made up of assets other than money, is an asset securitization trust. Specifically, there are real estate trusts and monetary claims trusts. Real estate trusts total approximately 45 trillion yen, and monetary claims trusts approximately 42 trillion yen. The next page will explain how the fundamental functions of trusts are utilized in asset securitization trusts. Simply put, securitization is the use of trust functions to transform something which is not money into a kind of financial instrument. In this section, I will talk about housing loan monetary claims, which are held by financial institutions that extend housing loans. First, a financial institution that holds housing loan monetary claims uses the property right conversion function of trusts to transform their claim into trust beneficiary rights through a trust bank. This step makes use of the property right conversion function. The financial institution then splits the trust beneficiary rights and sells them to investors. These investors are then entitled to receive payments on principal and interest amounts on the home loan in the form of dividends from their trust beneficiary rights. Normally, these payments would have been received by the loan issuing bank. In this process, investors are able to receive higher investment yields than they could with regular bank deposit accounts. Additionally, the claim to principal and interest payments on housing loans will not be lost in the event of bankruptcy on the account of the issuing bank or the trust bank. The bankruptcy and isolation function of trusts ensures this. What's more, from the issuing bank's perspective, a loan which would have taken nearly 20 years to recover is essentially recovered all at once, enabling them to put these funds to other home lending issues. In this way, while the housing loan monetary claims held by financial institutions are not cash money, by using asset securitization trusts, these monetary claims become the raw material for new financial products and are transformed into money. This is how securitization takes place. These asset securitization trusts lost momentum following the 2008 financial crisis, but have since recovered in recent years and are expected to develop into a new market for trusts. In the world of money flow and other fields, we can understand the following about trusts. Number 1. Trusts make use of trust products, which combine basic trust functions. Number 2. Trusts play a behind-the-scenes role in connecting households and investor funds to financial markets as part of the financial infrastructure. Number 3. Trusts create new financial intermediary and asset management functions as seen in asset securitization. And number 4. Trusts contribute to economic growth and the resolution of issues. In this way, trusts have the flexibility and applicability to respond to a variety of needs and issues. This is the essence of trusts. In recent years, there has been a growing need to clarify objectives with the investment of financial assets rather than simply to increase the funds in a haphazard pool of assets. For example, there is an increasing need for individuals to manage funds according to their life stage, such as managing funds for daily living separate from future retirement funds, providing education funds for children and grandchildren, and preparing for inheritance. Trust banks have responded to these needs by developing a variety of trust products, such as educational funding trusts, security support trusts, and singles trusts. The other lectures in this series introduce a variety of instances in which trust can be put to good use. Please check them out. Thank you for your kind attention today.